Mark, good to see you. Today we get to talk through how to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are now finally coming down. That means it's time to rethink how we're investing. So first, why is the Fed now lowering rates?
Well, that's a great question, Aaron. Obviously, if we've been monitoring what the Fed has been doing all along while they've been raising rates, it's all been what we call data dependent. So they're looking at data and making decisions based on the data. Now, ultimately, as inflation has decreased in a lot of these different areas, what they've ultimately said is, hey, if we want to get to a really it's a 2% target rate on overall inflation, how they look at inflation. And we're pretty close to that. But ultimately, the reason they lowered rates was so that they don't continue to keep so restrictive that they throw us into a recession. I mean, that's ultimately, the bottom line. They are trying to engineer as best they can what we call a soft landing, which avoids a recession.
Right. Okay, so what is the biggest difference when it comes to investing when rates are on the decline?
Well, we have to take into consideration because, the risk-free rate used to be 5% or a little over 5%. Well, now that's on the decline. So what you're going to see is money market yields, CD yields coming down. And then there's going to be some stocks that are going to be, some sectors of the economy that are going to be ultra sensitive to interest rates decline, meaning more positive. So we really need to look at our portfolios and maybe make some rebalancing decisions into some of those sectors that can really benefit from that interest rate decline.
All right, well, let's start ticking through those. I want to hear specific investments that we should maybe be considering right now. And one of them would be those high yield investments.
Yeah, so high yields has always been an area where you have much higher yields, but as interest rates come down, they appreciate very quickly. They actually act like equities. So that's a very good place to be to get some higher yield or interest with potential capital appreciation as interest rates come down.
Mm-hmm.
Then we have bond ETFs. Obviously, anything we have to remember, there's an inverse relationship between price and where interest rates are going. So as interest rates decline, bond prices go up. So the bond market is looking very good and has appreciated tremendously, in the last couple of months.
Mm-hmm.
Then we can look at preferred stocks. Obviously, preferred stocks pay a yield. So again, what's the underlying theme here? Things that pay dividends that have yield. So preferred stocks can be a very good place to be. As well, the real estate market, it's been an underperformer for the last couple of years. But if you looked in the last few weeks, it's perked up. And that's because, interest rates are on the decline. And, obviously that's going to affect mortgage rates and the amount of people that are buying houses. So ultimately, that's going to be a positive impact to real estate investment trusts.
Yeah. And you know what, Mark, I'm really glad we got to talk this through because I think it's a timely conversation and experts are predicting more rate cuts as the year goes on. If somebody wants to talk to you more about those specific investments, how can they get a hold of you?
Yeah, it's real simple. I mean, you can call our office. It's 303-681-0113. And anyone on our team would love to talk to you. We can set up an appointment. It can be a phone call, a Zoom call, whatever you would like to kind of discuss these things. Or you can go to our website, mcgregorwealth.com. And ultimately, we have in there, you'll see a calendar link. And you can actually set up an appointment and it'll directly link to my calendar.
Really easy. All right, Mark, thanks so much for your help today.
All right. Thank you, Aaron. Have a wonderful day.